3 weeks ago, a routine SEC filing revealed something unusual. The Bill and Melinda Gates Foundation Trust had reduced its Microsoft holdings by approximately 2/3 in a single quarter. While large portfolio adjustments aren't uncommon among billionaire-managed trusts, the scale and timing caught analysts' attention. When examined alongside similar SEC filings from other high-profile investors over the past 6 months, a pattern emerges. Approximately $89 billion in combined equity sales by billionaire insiders, coupled with strategic shifts toward defensive assets. According to publicly available SEC 13F filings between July 2025 and January 2026, several notable transactions stand out. Jeff Bezos sold $8.5 billion in Amazon stock, representing his largest single-year liquidation and a dramatic acceleration from his historical pattern of selling no more than $3 billion annually. Mark Zuckerberg offloaded $500 million in Meta shares during the same period. Perhaps most striking was Jamie Dimon's decision to sell $150 million in JP Morgan stock, marking his first sale since 2005. For a CEO who has led the bank for 18 years and maintained his holdings through the 2008 financial crisis, the COVID-19 pandemic, and multiple market corrections, this timing raises questions about what he sees in the bank's loan books and derivative positions. The Gates Foundation's portfolio reallocation deserves particular scrutiny. Microsoft, once comprising 28.6% of the foundation's holdings, now represents just 12.8% following the third quarter 2025 sales. This represents a 55% reduction in weighting of a company that remains fundamentally strong, highly profitable, and well-managed. The foundation didn't simply liquidate and hold cash. Instead, it reallocated capital toward 3 specific assets: Berkshire Hathaway, Waste Management, and Canadian National Railway. These choices reveal a deliberate strategy rather than random diversification. Berkshire Hathaway represents a proxy for cash with optionality. Warren Buffett's conglomerate currently holds $325 billion in cash and treasury bills, earning approximately 5% risk-free. This massive cash position isn't deployed in acquisitions or stock purchases despite Berkshire's historical preference for putting capital to work. Buffett himself has acknowledged in annual letters and interviews that he struggles to find attractively priced investments in the current environment. By increasing exposure to Berkshire, Gates is effectively positioning for whatever opportunities emerge when valuations reset. If markets decline, Berkshire deploys that cash to acquire quality assets at discounted prices. If inflation accelerates, Berkshire's diversified operating businesses provide pricing power. The investment offers defensive characteristics while maintaining offensive capability. Waste management represents pure defensive positioning. Trash collection generates steady cash flows regardless of economic conditions because waste production doesn't significantly decline during recessions. The company operates with near-monopoly characteristics in many regions due to insurmountable regulatory barriers around landfill development. No new competitor can easily enter the market. When costs rise, waste management companies raise prices. When economic growth slows, volumes remain relatively stable. Gates now holds over $7.5 billion in this recession-resistant asset. Canadian National Railway completes the defensive trilogy. Railroads move essential freight, coal, grain, oil, containers, as long as the economy functions. Canadian National operates the only transcontinental rail network in North America connecting 3 coasts, making it irreplaceable infrastructure. Like waste management, it generates predictable cash flow with pricing power. These aren't growth stocks or speculative plays. They're bunker assets, the kind of investments sophisticated investors hold when expecting market turbulence. Warren Buffett's actions provide additional context. Berkshire Hathaway has been a net seller of equities for 3 consecutive years, an extraordinary departure from Buffett's 6-decade philosophy of buying and holding quality businesses. His largest sale involved reducing Berkshire's Apple position by approximately 15% in the third quarter alone. Apple previously represented 50% of Berkshire's equity portfolio but now constitutes roughly 30%. Buffett has called Apple one of the best businesses in the world, yet is systematically reducing exposure. At 33 times earnings, Apple's valuation prices in perfection. Any revenue miss or margin compression could trigger significant price declines. Buffett is selling while the stock remains expensive, accumulating cash for future deployment when better opportunities emerge. Several market indicators provide context for these portfolio shifts. The S&P 500 currently trades at 22.2 times forward earnings, a premium to both the 5-year average of 20 and the 10-year average of 18.7. According to FactSet Research, the S&P 500 has sustained a forward price-to-earnings ratio above 22 during only 2 periods in the last 40 years, the dot-com bubble from 1998 to 2000, and the post-pandemic stimulus bubble from 2020 to 2021. Both periods ended in significant market declines. The dot-com crash saw the S&P 500 fall 49% peak to trough. The 2022 correction resulted in a 25% decline. Current valuations sit in that same elevated range. Market concentration adds another layer of concern. 7 stocks, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, account for 32% of the S&P 500's total market capitalization. This represents the highest concentration since the Nifty 50 era of the 1970s. When everyone owns the same stocks, when passive index funds mechanically buy more of the largest holdings due to their weighting, the flow becomes self-reinforcing during bull markets. However, this dynamic reverses during downturns. When selling begins, index funds must liquidate their largest holdings first to raise cash, pushing prices down and triggering additional selling in a cascading effect. The ratio of insider sells to insider buys reached 4.7 to 1 in December 2025, meaning corporate insiders sold 4.7 shares for every share they purchased. This represents the highest ratio since 2007, immediately before the financial crisis. CEOs, CFOs, and board members who understand their businesses intimately are selling, not buying. Meanwhile, retail investors continue accumulating shares through 401k contributions, index fund purchases, and ETF investments. This divergence between insider behavior and retail behavior has historically preceded significant market corrections. Economic indicators suggest growing headwinds. The unemployment rate increased from 3.6% in April 2025 to 4.2% in December 2025. The SARM rule, a recession indicator developed by economist Claudia Sahm, states that when the 3-month moving average of the unemployment rate rises by half a percentage point or more relative to its low in the previous 12 months, the economy is either in recession or one is imminent. The recent rise of 0.6 of a percentage point has triggered this indicator. Consumer financial stress is evident in credit card delinquency rates reaching 6.8% in the third quarter of 2025, the highest level since 2011. Auto loan delinquencies hit 5.6%, the highest since 2010. These metrics suggest consumers are struggling with debt service as savings rates have fallen to 4.4%, among the lowest levels in decades. Corporate debt presents additional concerns. Corporate debt to GDP stands at 110%, higher than pre-2008 financial crisis levels. Companies borrowed trillions at near-zero interest rates during the pandemic. As this debt gets refinanced at current rates of 3.5% to 4%, companies face interest expenses 4 times higher than their original borrowing costs. Businesses that were profitable with 1% debt service costs may become unprofitable at 4% rates. High-yield credit spreads are widening as bond markets price in increased default probabilities. The technology sector faces specific uncertainties around artificial intelligence investments. Microsoft, Amazon, Google, and Meta have collectively spent over $200 billion on AI infrastructure, data centers, GPUs, energy systems, over the past 2 years. While products like ChatGPT, Copilot, and Gemini demonstrate impressive capabilities, the revenue generated from AI products doesn't yet justify the capital expenditure. Investors are beginning to question when these investments become accretive to earnings and whether the returns will ever materialize at the scale required to justify current valuations. The $89 billion in insider sales doesn't guarantee an imminent market crash, but it does indicate that sophisticated investors with access to proprietary information and analysis are repositioning portfolios. Whether this represents prudent risk management in an expensive market, prescient positioning ahead of economic deterioration, or simply coincidental timing remains uncertain. What's clear is that billionaire investors are reducing equity exposure, shifting toward defensive assets, and building cash reserves. For individual investors, the relevant question isn't whether to panic and sell everything, but whether current portfolio positioning accounts for multiple scenarios, including the possibility that elevated valuations mean revert, that economic growth slows more than expected, or that unforeseen shocks trigger volatility. The lesson from observing billionaire portfolio shifts isn't to mirror their exact moves, but to ask whether your own portfolio reflects appropriate risk management given current market conditions and personal financial circumstances.